If you are a kind of investor who checks market every day, gets scared during market crashes, but still wants high returns, then you are a hybrid investor. People who want growth without anxiety and stability without sacrificing returns. Hybrid fund is the most misunderstood category in India, but also the most intelligent invention in mutual funds. It is like a well-balanced thali, not too spicy, not too sweet, just a right mix for your stomach and also for your portfolio. In today's video, I will break down hybrid funds for you. How do they work, who should invest, and how to choose the best fund using some of the smartest technique. Namaste friends, I am Rohini and you're watching the knowledge series of Fincash.com. Here is a simple way to understand them. Hybrid fund is a mix of both equity and debt in a portfolio. Hybrid funds are designed for behavioral correction because most of the investors behave like this. For example, when market rises, they want 100% in equity, and when market falls, suddenly they want 100% in debt. So hybrid funds prevent this emotional flip-flop by automatically balancing the two. SEBI created 7 categories of hybrid mutual fund, and each category has a strict rules which will be discussed ahead in this video. So hybrid funds just do not manages your money, it manages your behavior. And behavior decides 80% of long-term returns, not market. So hybrid fund is a perfect for investors who want growth, stability, and emotional control without checking markets every day like a stock addict. Now let us decode the real magic of hybrid funds. That is how actually they work behind the scenes. So hybrid funds follow a very scientific balancing system known as asset allocation and rebalancing. And this one technique has created more wealth globally than stock picking. Let me explain you this in a very simple way. When equities goes up, hybrid funds sell high. Say equity suddenly rises 15 to 20%. A hybrid fund will reduce equity and shift that money into debt. This protects you from overexposure at the top. Second is when market falls, hybrid funds buy low. During market corrections, equity becomes cheaper. So hybrid funds increase equity exposure automatically, meaning they buy more units at lower prices even when human investors are scared. This is opposite of what most people do. Humans panic. Hybrid funds stay logical. Third is smoother and behavior proof returns. Here you do not get the roller coaster of equity, but you also don't get that slow pace of debt. You get something that is right in the middle. A return path that actually a human mind can handle. And that is why hybrid funds can beat pure equity during market crash, and it can also outperform debt during market recoveries. This is the psychological advantage of hybrid. Now we will look into 3 engines that drive hybrid funds performance. Every hybrid fund's returns come from 3 sources. That is, hybrid funds create returns from 3 engines and most investors only know about one. Let me break it down. Equity alpha, that is your growth engine. Hybrid funds invest a portion in equity. This part gives long-term growth, exposure to market cycles, and sometimes extra return, that is alpha. Even though it is not pure equity fund, you still participate in India's long-term growth history. Second engine is debt stability, that is your safety net. The debt portion invests in government bond, AAA rated corporate bonds, high quality money market instruments. This gives steady interest income, consistent base return, and much lower mortality. So even when market crashes, your portfolio doesn't collapse with it. The third engine is rebalancing effect. This is the hidden power. Hybrid funds can automatically rebalance. Buy low, sell high. It happens on an autopilot without emotion, without timing the market, and without you doing anything. This built-in discipline feels steady when the markets are not. So hybrid funds do not outperform by taking more risk. It outperforms by removing bad decisions. Now let us look at the types of hybrid funds. First one is conservative hybrid funds. Think of this as your safer cushion of hybrid funds. They invest 75% to 90% in debt and 10 to 25% in equity. So what do you get in this fund? You get stability of debt and smaller booster from equity. Conservative hybrid fund is ideal for people who want better interest than FDs, that is fixed deposits, without taking big risk. The second type is balanced hybrid fund. These funds invest 40 to 60% in equity and rest in debt. It's literally a perfect equilibrium. Not too aggressive, not too defensive. Great for people who want smooth long-term growth with lower volatility. The third option is aggressive hybrid fund. These funds invest 65 to 80% in equities and rest in debt. They behave like equity funds, but they are much more smoother. So if you want equity-like returns but do not want to go through that roller coaster ride, this fund can be ideal for you. The next one is dynamic asset allocation. So this is a genius fund. There is no fixed rules of allocation between equity and debt. If markets are expensive, it shifts to debt. If markets are cheaper, it moves to equity. It buys low, sells high, and protects you from yourself. The next type is multi-asset allocation fund. These funds invest in 3 assets, usually equity plus debt plus gold, each minimum 10%. So even if one asset falls, another picks up the slack. This is perfect for people who want true diversification without managing multiple funds. The next type of hybrid is arbitrage fund. These type of fund do not take risk of equity at all. They profit from price differences between cash and future market. They behave like liquid funds but are taxed like equity. That's the entire appeal. The next type of hybrid fund is equity savings fund. These funds mix arbitrage, debt, and a small portion of equity. So you get stability, good tax efficiency, and low volatility. It is ideal for conservative investor who still wants tax efficient returns. I will show you 7 concepts that will help you to shortlist some of the best performing mutual funds, or in this case, good hybrid funds for you to invest. Let us look at concept number 1, that is rolling returns. It reveals how consistently a fund performs across market cycles. It helps you assess its volatility and long-term potential. So ideally, you should check for a fund stability over 3 years and 5 years cycle before investing. The second parameter is called Sharpe ratio. It shows return per unit of risk. So for hybrid funds, Sharpe usually falls somewhere between 0.5 to 1.2. If a fund is closer to the upper side of that range, it means the fund is giving better returns without unnecessary risk. The third parameter is Sortino risk. It shows you how a fund manages well during bad markets. Hybrid funds typically fall in 0.8 to 1.5 range. If a fund consistently stays on a higher side, that means it protects you better during market downturn. The fourth parameter is standard deviation. It shows you how stable or jumpy a fund is. Most hybrid funds move within 7% to 12% volatility range. Funds closer to the lower end of this range tend to offer a smoother, calmer investing experience. The fifth parameter comes the expense ratio. We can say that it is a silent wealth killer that most investors do not know or they ignore. Two funds may look identical, but if one charges even 0.5% more over 10 to 15 years, that small number can cost you lakhs. Hence, it is advisable for you to check the expense ratio of the funds you're shortlisting. This will help you save money in your returns. The sixth parameter is the portfolio quality. Any fund is good only if the ingredient inside that fund is good. For example, in which company they invest, in which bonds they invest. Quality matters the most here. On the equity side, we want strong large cap companies, controlled mid cap exposure, and proper sector diversification. On the debt side, we should look for clean, high quality AAA rated bonds with low credit risk and sensible duration management. Last but not the least is fund manager. The fund manager is the hero behind your fund. Because hybrid funds depend heavily on managers' ability to balance equity and debt at the right time, a good manager here plays a huge role. Someone who has experience across multiple market cycles is always a better choice. While choosing a hybrid fund, make sure that the category matches your financial goal. For example, a conservative hybrid fund isn't for somebody who's chasing for high growth. At the same time, an aggressive hybrid fund isn't suitable for somebody who panics when the market falls sharply. Your risk appetite, your time horizon, and your emotional comfort with volatility must all align with the category you choose. In this phase, we will look at actual hybrid funds and how they have behaved with real numbers. So, for illustration, we are taking two funds, that is SBI Equity Hybrid Fund and another is HDFC Balanced Advantage Fund. So, SBI Equity Hybrid Fund is an aggressive fund, and over the last 5 years, it has delivered around 15 to 16% annual returns, even when the market went through ups and downs. 72% of its fund is in equity for growth and 22% sits in debt. Whereas HDFC Balanced Advantage Fund, which is a dynamic asset allocation fund, in 5 years annual return, it has roughly delivered 12 to 14%. But the important part is, this fund doesn't keep a fixed equity debt ratio. Instead, it increases equity when markets are cheap and reduces equity when markets become expensive. So we have looked at the two examples within the hybrid category, which has two different investment approach and both have delivered quite a good returns. Like this, there are quite a few hybrid funds that has delivered consistent returns over last few years. If you want to explore all of them at one place, you can visit Fincash Explore Fund page. In the home page, you will find Explore Funds option. Go to the extreme left, select for hybrid funds, and on the extreme right, you will find customized fund fields where you will get all the parameters you can select, such as Sharpe ratio, expense ratio, minimum investments, absolute return ranging from 1 month to 5-year CAGR return. You can compare these parameters and make a wise decision for your better investments. Before we wrap up, here is something very important that every investors need to remember. Wealth doesn't just grow because you have picked a right fund. It grows because we have started and we stay invested, we are consistent, and we let the time do its job. Market will rise, fall, confuse us and frighten us. But money has only one rule. It revolves to people who stay in the market for the long run, not chasing the return, not predicting the next market fall, but building a systematic system that helps you stay invested in a calm, disciplined way, and that one which prepares you for long financial journey. If you just get this part right, your wealth will not just grow, but it will compound in such a magical way that most people have never experienced before. It is your money, invest it smartly.